You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
So imagine walking into like a really high-end casino. You step through the velvet ropes, and over at the VIP tables, you've got these so-called professional gamblers.
Oh, yeah, the guys in the bespoke suits.
Exactly. The bespoke suits, they have teams of statisticians just like whispering in their ears. They've got proprietary software analyzing the dealers' every twitch. And they are charging you a massive premium just for the privilege of watching them play with your money.
Right, which sounds great on paper until you look at the actual math.
Yeah, because here is the crazy catch. As of 2025, these VIPs, they lose to the house 62% of the time.
Wow.
Meanwhile, there's a person sitting in the corner playing the penny slots in sweatpants who just automatically wins just by sitting there. So the question for you, if you're listening to this deep dive today, is why on earth would you pay the VIP a premium fee to play your hand?
You wouldn't. I mean, you absolutely wouldn't. But for decades, that is exactly what we all did with our retirement accounts.
It really is. And today, we are going to follow the money. Literally trillions of dollars. We're breaking down exactly how the house is finally losing and how everyday investors are, well, basically weaponizing math against Wall Street.
Yeah, and we're looking at a permanent structural shift here. It's not a fad.
Right. So let's get into the sources, because we are synthesizing 4 completely different financial guides today to give you the ultimate playbook. We've got a massive 2026 active versus passive data report from Synergistic Financial Advisors. We've got Vanguard's own internal methodology. We've even got some personal advice from Mark Cuban.
Which is fascinating considering his background.
Oh, totally.
Right.
And we're capping it off with a 19-step practical beginner's guide. The whole mission here is to just cut through the Wall Street jargon. We want to give you a low-stress, highly effective roadmap to building wealth without getting absolutely eaten alive by fees.
And setting the stage here, the numbers coming out of these latest 2026 reports, they confirm that this is basically an autopsy of the traditional active management industry.
An autopsy. I love that word for this.
Well, it is. The investing public has fundamentally woken up to the mathematical reality of how wealth is actually compounded. Mm-hmm. And they're voting with their wallets at a scale that is, frankly, staggering.
Staggering is the right word. Let's look at the Synergistic Financial Advisors report. This maps out the global asset shift, and the tipping point, it's officially behind us.
Yeah, the lines have crossed.
In May of 2026, the combined assets of index mutual funds and ETFs reached $21.82 trillion.
Trillion with a T.
Trillion with a T. That officially surpassed actively managed fund assets, which sat at $18.85 trillion. So the penny slot players have overthrown the VIP room.
They bought the casino.
Right. And to understand the velocity of this, in that single month, just May 2026 alone, long-term index funds saw a net inflow of $96.47 billion. Actively managed funds, just $11.08 billion.
It's a complete capitulation by the market. And it's really driven by this fundamental realization about the mechanics, right? Like, what is an index fund versus an active fund?
Yeah, let's define those terms for anyone who might be slightly fuzzy on the exact mechanics. In plain English, what are we actually talking about here?
Sure. So for a long time, the financial industry sold this idea that an index fund was just, a lazy, static list of companies. You just buy the list and go to sleep.
Boring, right? That was the narrative.
Exactly. But an index fund that tracks a major benchmark, like the S&P 500, it's actually this highly ruthless, self-cleansing momentum strategy.
Ooh, self-cleansing. Explain that.
Well, because it's market cap weighted. As a company succeeds and its stock price grows, it automatically becomes a larger percentage of the index. You are inherently buying more of the winners as they grow.
Oh, so nobody has to sit there and decide to buy more Apple. The math just does it.
Right. And conversely, when a company starts failing, when they stop innovating or their earnings collapse, their market cap shrinks. And they are mathematically phased out of the index without a human manager ever having to make a subjective judgment call.
Which is where the active funds get into trouble.
Exactly. The active fund relies entirely on subjective human judgment. You're paying a portfolio manager and their whole army of analysts to fly to corporate headquarters, scrutinize balance sheets, and try to predict the future.
Right, trying to find the needle in the haystack.
Yeah, and they're constantly buying and selling, trying to outguess millions of other highly educated analysts who are looking at the exact same information. So that mass migration of $96 billion in a single month, that tells us that investors have realized that human prediction is just a statistically losing game in a highly efficient market.
I hear that, and obviously the $21 trillion in index funds proves the point on a macro scale. But I want to talk about the psychological friction here.
Oh, the psychology is huge.
Because I think anyone listening to this right now probably feels a sense of FOMO, like fear of missing out.
Sure. It's human nature.
Right. Because if I just buy the index, I'm accepting the market quote-unquote average. And human beings are wired to hunt for the outlier. Like, if I'm investing my money for 30 years, shouldn't I want to find the person who can spot the next NVIDIA or the next Amazon before it just explodes?
Yeah, nobody wants to be average.
Exactly. If I just buy everything, it feels like I'm willingly leaving money on the table.
And that anxiety, that exact fear you're talking about, is what active managers have monetized for a century.
Selling the dream.
They sell the illusion of exceptionalism. But we have to completely reframe what the word average means in finance.
Right.
Because in this context, average doesn't mean like a C- grade in high school.
Yeah, right.
It represents ruthless mathematical efficiency. When you ask if you're missing out by not picking stocks, you really have to look at the Vanguard 10-year data ending in March 2026. It answers that definitively.
Yeah, this data blew my mind.
It's brutal. Over a 10-year period, 79% of active stock fund managers underperformed their designated benchmarks. And it's even worse for bonds. 83% of active bond managers underperformed.
So wait, by accepting the so-called average of the index, you are mathematically guaranteeing that you will beat roughly 8 out of 10 highly educated, highly paid professionals.
Yes. Professionals whose entire existence, literally their only job, is dedicated to beating you.
That is wild.
And it actually gets more brutal the further out you zoom. If we look at the SPV data, that's the S&P indices versus active scorecard over a 15-year period, a staggering 94% of active funds underperform index funds.
94%.
Yeah. In large-cap U.S. stocks, only 14% of active managers actually beat the S&P 500 over a decade and a half.
Okay, but let me play devil's advocate here, because the position is obvious. If 14% of managers beat the market over 15 years, well, those managers still exist, right? We have the data. Why can't I just, look at the historical charts, identify the 14% who are winning, and just give my money to them?
It's a great question, but the problem is that the historical charts you are looking at are essentially a statistical hallucination.
A hallucination?
Yeah, this brings us to survivorship bias, which is arguably the most dangerous blind spot for a retail investor.
Oh, this is such a crucial concept.
It really is.
Yeah.
When you pull up a chart showing the quote-unquote average performance of active funds over the last 20 years, you're only looking at the funds that survived long enough to be on the chart today. You're looking at a heavily curated data set.
It makes me think of the tightrope analogy. It's like judging the safety of walking a tightrope across a canyon by only interviewing the people standing on the other side. You're completely ignoring all the people who fell off.
That is the exact mechanism. Let's trace the actual life cycle of how this happens in the real world. So, a massive Wall Street firm launches let's call it the Alpha Growth Fund.
Catchy name. I'd buy it.
Right. So they raise $500 million. But for the first 2 years, they make a few bad bets, and the fund underperforms the market by, say, 10%.
Okay, so investors are getting nervous.
Exactly. Retail investors start pulling their money out. The fund drops into the bottom quartile of the Morningstar rankings.
Yeah.
Now, the Wall Street firm has this toxic asset on its books that makes their overall marketing look terrible. So what do?
They don't want to show that to new clients.
No. They don't keep running it, they close the fund. Or, what's actually more common, they quietly merge it into a larger, older fund that has a mediocre but, acceptable track record.
And when they merge it, the terrible historical data of the Alpha Growth Fund literally just vanishes from the databases.
Poof! It is scrubbed from the active management averages. And according to the SPVA research, over the last 20 years, nearly 64% of domestic stock funds completely folded or were merged out of existence.
64%?
64%. So when you try to pick that winning 14% based on past performance, you are picking from a deeply manipulated pool of survivors. And the manager, who got lucky and beat the market last year, is statistically highly likely to revert to the mean and underperform next year.
Which is why Mark Cuban's advice is so interesting there.
Oh, absolutely.
Because he is a guy who made his fortune through highly aggressive, active business moves. But he explicitly advises the average investor to just buy index funds because the structural advantages of indexing just bypass all that statistical noise entirely.
Yeah, Cuban knows that the game is rigged when it comes to active stock picking for retail investors.
It really reframes that entire concept of being average. Like, indexing isn't settling. It is a highly aggressive strategy that mathematically dominates Wall Street. But I have to ask, if these active managers are inherently brilliant people, and they have supercomputers, they have endless resources, what is the actual physical drag on their performance? Like, why are they losing so badly to a passive algorithm?
Well, it really comes down to the friction of fees.
Ah, fees, the silent killers.
Exactly.
Yeah.
Wall Street isn't running a charity, right? They are running a toll booth. And those tolls are the silent wealth destroyers in your portfolio.
So let's look at the numbers. The synergistic data outlines the current landscape.
Yeah, so the average expense ratio for an index fund is 0.11% annually. For active funds, you're looking at an average of 0.59%, and that often scales well over 1 full percent depending on the asset class.
And see, this is where the human brain is just terrible at processing fractions of a percent. When someone hears the difference between 0.1% and 1%, it sounds like a rounding error. It's less than a single penny on the dollar.
Which is exactly how the industry gets away with it. They quote fees in percentages, because if they quoted them in projected lost dollars, literally nobody would ever buy an active fund again.
Okay, let's translate it to dollars then. Break down the mechanics of how this drag compounds over a 30-year time frame.
Let's do it. If you invest $10,000, and let's assume the underlying stocks in both the active fund and the index fund perform identically.
Okay, so same exact market performance.
Right. They both generate a 7% gross return per year for 30 years. The index fund investor, paying basically nothing in fees, captures almost all of that compounding growth.
Makes sense.
But the active fund investor, paying a higher fee, sees their net return reduced to, say, 6.5%. Over 30 years, that tiny 0.5% difference in fees results in roughly $60,000 less in your pocket.
Wait. You're losing $60,000 on a $10,000 initial investment just to pay for the manager's bespoke suits.
Yep. And it scales dramatically as the numbers get bigger. If we look at the SEC's own educational data, they model an investor starting with $100,000 earning 4% annually over 20 years.
Go.
If that investor pays a 0.25% fee, they finish with $208,000. If they pay a 1% fee, they finish with $179,000.
Wow.
That is a $29,000 gap created entirely by the fee structure. It's completely independent of how well the actual companies in the portfolio performed.
And what's so devious about this is that you never actually see the bill. Like, no one from the mutual fund sends you an invoice for $29,000 that you have to sit down and write a check for. They just quietly siphon it off the top of your returns year after year.
And think about what that 1% fee means for the manager. They aren't starting the year at zero. They're starting the year in a 1% hole.
Oh, right.
They have to take on substantially more risk and beat the market by more than 1% just to break even with a passive index investor.
It's an uphill battle from day one, and I was looking at the SEC data on this, and the compounding drag of the expense ratio is bad enough, but the tax drag absolutely blew my mind.
Oh, taxes are huge.
We have to talk about tax efficiency because this is like the hidden second fee. Because active managers are constantly buying and selling to try and beat the market, they are constantly triggering capital gains events that the investor has to pay for, right?
Assuming you hold these funds in a standard taxable brokerage account rather than, a tax-advantaged retirement account, the tax drag can be devastating.
Walk us through how that actually works.
So when an active manager sells a stock at a profit to lock in a gain, or maybe they just pivot to a new strategy, that transaction generates a capital gain. And because they trade with such high velocity, many of these are short-term capital gains, which the IRS taxes as ordinary income. That is your highest possible tax bracket.
So let me get this straight. The manager is frantically trading inside the fund, and at the end of the year, the fund distributes those taxable gains to you. So you get handed the tax bill for all their frantic activity, even if you personally never sold a single share of the fund yourself.
Precisely. You are paying for their turnover.
Yeah.
Index funds operate on an entirely different mechanical level. Because they simply track the benchmark, they rarely trade.
Right, they just sit there.
The only time they really buy or sell is to accommodate investors putting money in or taking money out, or, like we said earlier, when a company drops out of the index.
Yeah.
This incredibly low turnover means they distribute almost zero taxable capital gains.
That's a massive advantage.
Huge! Over a 20 or 30-year compounding horizon, keeping that money invested and working for you. Rather than bleeding it out to the IRS every December, it creates this massive, almost insurmountable advantage for the index fund.
Okay, so the mechanics are undeniable here. The VIT room is a statistical trap. We know what the vehicle is: broad, low-cost, tax-efficient index funds.
Right.
But let's transition into the playbook. Because, handing someone the keys to a Ferrari doesn't help if they literally don't know how to drive.
Exactly. You need a map.
So the sources provide this highly practical 19-step framework for actually building the financial foundation required to hold these assets for decades without self-destructing.
And you have to build that structural foundation first. I mean, if your personal finances are chaotic, the best index fund in the world won't save you.
Where does it start?
The framework starts with the absolute basics, which is defining the goal. Why is this money being invested in the first place? Is it a down payment on a house in 5 years, or is it retirement in 30 years?
Right, because the timeline changes everything.
Exactly. The time horizon dictates the entire strategy. If you don't write down the specific destination, you have no anger when the market inevitably experiences a massive drawdown.
Which leads directly into the emergency fund. And I want to spend a minute here because people often view a cash emergency fund as like lazy money that isn't earning returns. They want all their money in the market.
Which is incredibly dangerous.
But the sources frame it perfectly. 3 to 6 months of living expenses held in liquid cash isn't an investment. It is a firewall protecting your investments.
Yeah, that's the exact mechanical function of it. If your essential monthly expenses are, say, $2,500, you need between $7,500 and $15,000 just sitting in a high-yield savings account.
Just sitting there.
Just sitting there. It exists entirely to prevent forced liquidation. If you lose your job or you have a massive medical expense and you don't have that cash firewall, you are forced to sell your index funds just to survive.
And if the market happens to be down 20% that specific month, you are permanently locking in that 20% loss. You've basically destroyed years of compounding because you needed cash for a transmission repair.
Yep. The emergency fund ensures you never have to interrupt the compounding process.
Okay, so once the firewall is built, the next foundational mechanic is addressing high-interest debt.
This is non-negotiable.
The framework forces you to look at the mathematical reality of debt versus investment returns. Let's say you're carrying credit card debt at a 20% annual percentage rate.
Carrying 20% debt while trying to earn 7 or 8% in the stock market isn't just a leaky bucket. It's like walking backward on a moving walkway.
Oh, that's a great visual.
You are mathematically moving backward by 12 to 13% every year, no matter how fast you step forward with your investments. Paying off that 20% debt is a mathematically guaranteed 20% risk-free return.
Which you can't get anywhere else.
Nowhere. There is no hedge fund manager on the planet who can guarantee a 20% return. Until that high-interest debt is eradicated, it is compounding against you way faster than any index fund can build wealth for you.
All right, so the goal is set, the cash firewall is built, the high-interest debt is eliminated. Now we get to account types. The sources are absolutely adamant about exploiting tax-advantaged accounts before putting a single dollar into a taxable brokerage.
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
It's all about tax arbitraging the government's rules. Like, if your employer offers a 401k match, that is step one.
Free money.
Literally free money. If they match 50% of your contributions up to 6% of your salary, that is an immediate 50% return on your money. It's the only free lunch in finance, and leaving it on the table is financial malpractice.
Okay, and beyond the match, you have to navigate the traditional versus Roth framework. Let's explain the mechanics of that, because the terminology constantly trips people up. It's essentially just a decision about when you want to take the tax hit, right?
Exactly. A traditional IRA, or 401k, provides a tax break on the seed. So you deduct your contribution from your taxable income today. The money grows tax-deferred, but you pay ordinary income taxes on the entire harvest, meaning the original money plus all the growth when you withdraw it in retirement.
Right. And then Roth is the opposite.
A Roth account flips the mechanic. You pay taxes on the seed today, so there's no upfront deduction, but the money grows completely tax-free, and you pay zero taxes on the harvest when you pull it out in retirement.
So if you're listening to this and you're in your 20s or 30s in a relatively low tax bracket today, but you expect to have millions of dollars and be in a higher tax bracket in retirement, the Roth mechanic is incredibly powerful. You are locking in today's low tax rate and sheltering decades of compounding growth from the IRS forever.
And that compounding growth is where the math gets truly staggering, especially when you leverage the concept of paying yourself first. The sources highlight how seemingly insignificant amounts of capital just explode over time.
I love these examples. Let's hear the number.
If you invest $200 a month into a broad index fund, earning a historical average of 7% over 30 years, that $200 a month grows into roughly $226,000.
Which is amazing on its own. But the mechanical leverage of adding just a tiny bit more capital is what really fascinates me.
Right, watch what happens.
If you increase that contribution by just $100, moving from $200 to $300 a month, that final total skyrockets to roughly $340,000. That extra $100 a month, which is like a couple of dinners out, generates well over $100,000 in additional wealth entirely because of the runway you gave it to compound.
But the only way that works, practically speaking, is through automation. The psychology of investing requires you to remove willpower from the equation.
Because if you have to choose to invest it every month, you won't.
You'll find a reason not to.
Yeah.
You set up the transfer so that the moment your paycheck hits your checking account, that $300 is automatically swept into the index fund. You never see it, you never budget for it, and most importantly, you execute a strategy called dollar cost averaging.
Dollar cost averaging, DCA, meaning you are buying no matter what the market is doing. The news cycle becomes irrelevant.
Exactly. By investing a fixed dollar amount every single month, you are mechanically forcing yourself to buy fewer shares when the market is expensive and more shares when the market crashes and goes on sale.
It's brilliant.
It completely eliminates the catastrophic temptation to try and time the market. You just ride the wave.
Okay, so we've spent this entire time basically proving that broad market indexing destroys active management. But the synergistic report introduces a concept that I think is incredibly nuanced. It asks the question, does this mean active management is completely 100% useless in all scenarios?
And the answer is actually no.
Right. The answer they provide is a strategy called Core and Explore. Now, Core and Explore makes perfect sense on paper, but practically, how does an average person identify where active management actually works?
This is where you have to look at the mechanics of market efficiency. The core of your portfolio, which should be 60 to 80% of your total assets, must be built entirely out of broad, low-cost index funds.
Okay, so mostly index funds.
Yes. You use index funds for markets that are hyper-efficient. We're talking about large-cap U.S. equities, like the S&P 500, and massive investment-grade bond markets.
Let's break down why large caps are hyper-efficient. It's really because of the sheer volume of processing power pointed at them. Right?
Precisely. Think about a company like Apple or Microsoft. You have thousands of professional Wall Street analysts, algorithmic trading systems, hedge funds, sovereign wealth funds, and they are analyzing every supply chain rumor, every consumer sentiment shift, every quarterly whisper.
It's a massive hive mind.
The second a piece of news breaks, those algorithms instantly buy or sell. They digest that information and adjust the stock price in literal milliseconds. The current price of Apple stock perfectly reflects all publicly available information on Earth at that exact second.
So there is zero informational edge. It is mechanically impossible for a human fund manager sitting in an office in Manhattan to know something about Apple that the collective hive mind of the global market hasn't already priced in. That is why the core must be indexed. You're just paying high fees for a human to fail at beating a supercomputer.
But then we look at the Explore bucket. This is the remaining 20 to 40% of the portfolio, where targeted active management can actually mathematically justify its existence.
Where can a human manager actually win?
In the dark, inefficient, obscure corners of the global market, think about small-cap stocks, emerging markets, or high-yield frontier bonds.
A great example from the research is a Vietnamese small cap manufacturing fund. Like, there aren't 10,000 algorithmic trading bots hyper-analyzing a regional logistics company in Hanoi.
Exactly. In those inefficient markets, information does not travel at the speed of light. Deep domain expertise, localized on-the-ground research, and human relationships actually matter there.
So a human can actually get an edge.
A skilled active manager can fly out there, audit the factories, understand the local regulatory environment, and find a massively mispriced, undervalued company long before the global market algorithms even know the company exists. In those very specific, inefficient spaces, a manager's ability to generate alpha, to actually beat the benchmark, can genuinely justify their fee.
But, and this is a big but, even in the Explore bucket, the sources emphasize a massive flashing warning sign regarding the cost screen.
Oh, the data is brutal on this point. Even if you are buying an active emerging markets fund where human research is valuable, the most significant predictor of that fund's future success is not the manager's Ivy League resume. It's not their past performance.
It's the fee.
It is the expense ratio. It only makes statistical sense to buy an active fund if it falls in the absolute cheapest quintile of available active funds, meaning it charges 0.25% or less. High-cost active funds are universally toxic to your wealth, regardless of how inefficient the asset class is. The fee hurdle is just too high to clear.
There's another really interesting mechanical nuance here regarding when you might want to use active management. And this is specifically concerning the sequence of returns.
This is critical for anyone approaching retirement. Let's compare a 30-year-old and a 68-year-old.
Okay.
When you are 30, you are in the accumulation phase. If the stock market crashes by 30% tomorrow, mathematically, you do not care.
You shouldn't care.
In fact, you should celebrate because your automated monthly contributions are now buying shares at a massive discount. You have 30 years for the market to recover.
But if I'm 68 and I just retired on Friday and on Monday the market drops 30%.
That changes everything.
Yeah.
That is what the industry calls sequence of returns risk. If you experience a massive market crash at the exact moment you transition from accumulating wealth to withdrawing wealth to live on, it can permanently devastate your portfolio.
Because you're selling at the bottom.
Yeah. Because you are forced to sell shares at rock bottom prices just to buy groceries. You permanently deplete the capital base that you need to generate future growth. You can never recover from that math.
So in this specific scenario, an index fund is actually kind of dangerous because it's completely blind. An S&P 500 index fund will just enthusiastically ride the market all the way to the bottom of the canyon.
It has no brakes. And this is where an active manager, specifically in fixed income or defensive equity strategies, provides massive value.
Because they can see the cliff coming.
A human manager can see the macroeconomic storm clouds gathering. They can actively choose to raise cash. They could shorten the duration of their bond holdings to protect against interest rate spikes, or tilt the portfolio toward highly defensive, dividend-paying sectors. They can play defense to preserve your capital.
So for a retiree, that makes sense.
For a retiree withdrawing funds, paying a slightly higher fee for an active manager to manage downside risk and smooth out the volatility, that can be the difference between a comfortable retirement and running out of money at age 80.
So the Core and Explore framework is brilliant. You relentlessly index the highly efficient core to keep costs near zero. You use low-cost active funds to explore inefficient international niches. And you utilize active defense when you transition into the withdrawal phase of your life.
It is a mathematically perfect plan.
But here is where we hit the final and frankly the most difficult hurdle. You can have the perfect asset allocation, perfectly optimized for taxes and fees. What is the single biggest point of failure in this entire system?
The single biggest point of failure is human neurology.
Us. We are the problem.
It is the biological wiring of the person looking at the portfolio.
It's the psychology of panic. The Vanguard and Morningstar data we referenced earlier highlights a mind-blowing statistic. The average retail investor loses roughly 2 to 3% of their potential returns annually, not to fees, not to taxes, but entirely due to their own bad behavior.
We are actively destroying our own compounding.
Explain the biology of that. Why do we do it?
It's driven by the dopamine loops of a bull market and the absolute terror of loss aversion during a bear market. Humans are biologically wired to run with the herd. When the market is surging, everyone is making money, your neighbor is bragging about their tech stocks, and dopamine drives you to buy in.
You're chasing performance.
You're chasing performance. And mechanically, You're buying at the absolute peak of the market when assets are their most expensive.
And then the market corrects, it drops 20%. The financial news networks put up all those flashing red graphics, everyone screams about a recession, and loss aversion kicks in.
And the psychological pain of losing a dollar is mathematically twice as intense as the joy of making a dollar.
So the investor panics, logs into their brokerage account, and hits the sell button to quote-unquote stop the bleeding. Mechanically, they are selling their assets at rock-bottom prices.
They have successfully executed the exact opposite of how wealth is built. They bought high and sold low. This behavior completely vaporizes wealth.
Which is why the sources argue that the true quantifiable value of a human financial advisor isn't in picking hot stocks or designing complex portfolios.
No, a good advisor's highest mathematical value is acting as a behavioral firewall.
A therapist, basically.
Essentially, yes. They operate as a physical and psychological barrier between you and the sell button during a global panic. If you call your advisor sweating bullets because the market is down 20% and they talk you off the ledge, remind you of your written 30-year goal, and prevent you from liquidating your portfolio, they've instantly earned their entire 1% fee for the next decade.
They deliver massive alpha simply by enforcing discipline.
Exactly.
But let's say someone is listening to this and they are fully committed to a DIY approach. They don't want to pay an advisor an assets under management fee. How do you mechanically enforce that kind of ruthless, emotionless discipline on yourself?
You utilize a systemic mechanical process called portfolio rebalancing. Rebalancing is how you completely strip human emotion out of your investment decisions.
Walk me through the exact mechanics of this, because I know the concept, but executing it feels deeply counterintuitive when you are actually in the trenches of a market cycle.
Let's look at the math. Let's say your written financial plan dictates a target asset allocation of 60% stocks and 40% bonds. That ratio is your baseline. It reflects the exact amount of risk you need to take to hit your goal without losing sleep.
Okay, 60-40.
Now, let's say we enter a massive multi-year bull market. Stocks are absolutely soaring, up 20% a year, while your bonds are just steadily grinding out a boring 4%.
Over a few years, because the stocks are growing so much faster, the underlying weight of the portfolio completely shifts.
Exactly. You wake up 3 years later, you log into your account, and because of that unequal growth, your portfolio has drifted. You are now holding 75% stocks and only 25% bonds.
So my risk exposure is now massively higher than I originally designed. I am overexposed to equities right at the peak of a bull market.
Which is the most dangerous time to be overexposed. So once a year, on a predetermined date, you execute a rebalance. You look at that 75-25 split, and you force it back to your target of 60-40.
And this is where the human brain just screams in protest. You are telling me that in the middle of a raging bull market where my stock index funds are making me incredibly wealthy, I have to sell off a massive chunk of those winning stocks, take that cash, and use it to buy more of the boring bonds that are currently lagging behind.
I know it sounds crazy.
Mechanically, I am selling the winner to buy the loser. That feels completely wrong.
I know it feels like punishing success.
Yeah.
But look at what the math is forcing you to do. By systematically selling the stocks that have surged in value, you are mechanically taking profits off the table. You are selling high. And by taking that cash and buying the bonds that have lagged, you are buying an out-of-favor asset class at a discount. You are buying low.
It is the golden rule of investing, executed automatically.
Rebalancing is the only mechanical system that forces you to buy low and sell high without requiring you to predict the macroeconomic future. It removes greed during a bull market by forcing you to trim your winners, and removes fear during a bear market by forcing you to buy into the panic to bring your stock allocation back up to 60%. It systematically resets your risk profile while locking in gains.
We have covered a massive amount of ground today, pulling from highly technical data down to the raw psychology of how we interact with our money. But the through line connecting all of this is incredibly clear, and honestly, it is deeply empowering.
It really is.
If you're listening to this deep dive, the path to building real generational wealth does not require you to have a finance degree. It doesn't require you to read the Wall Street Journal every morning, or stare at candlestick charts, or pay a VIP in a bespoke suit to gamble with your future.
It requires a mechanical plan and the psychological discipline to execute it over decades.
Exactly. It requires setting a clear written goal to anchor your behavior. It requires eradicating high-interest debt, because you can't walk backward on the moving walkway and expect to build wealth. It requires building a cash emergency firewall so you never have to interrupt your compounding. It requires arbitraging the tax code through Roth and traditional accounts.
Check, check, check.
And most importantly, it requires putting the vast majority of your wealth into broad, low-cost index funds, automating those contributions so you never have to rely on willpower, and letting the relentless efficiency of global markets do the heavy lifting for you.
The data proves that simplicity and low friction mathematically dominate complexity and high fees.
Right.
But if we project this massive trillion-dollar shift toward index funds into the future, it does raise one final, incredibly fascinating paradox.
I love a good paradox. What's the blind spot in the indexing revolution?
Well, we've established that index funds are winning because they just blindly buy the benchmark. They don't analyze balance sheets. They just buy whatever's already in the S&P 500 based on its current price.
Right.
But that current price is set by active managers fighting with each other over what the company is actually worth. So if this trend continues to its absolute logical extreme, if eventually 99% of global wealth passively invests in index funds without ever analyzing the underlying fundamental value of a company who is left in the market to actually determine the true price of the stock.
Whoa, wait. If nobody's looking at the fundamentals and everyone's automated monthly transfer is just blindly buying Apple because it's the biggest slice of the pie, the entire price discovery mechanism of capitalism completely breaks down.
Exactly. The brilliant irony of this entire ecosystem is that as passive indexing continues to dominate and drive active managers out of business, the market will inherently become less efficient.
Because there's no one doing the research.
Right. And as the market becomes less efficient and prices decouple from reality, the few active managers who remain will suddenly have massive historic opportunities to find mispriced stocks, which will potentially make active management highly valuable once again.
That is wild.
The very success of the index fund might eventually resurrect the need for the active manager to save the market from its own passive efficiency.
That is an incredible thought to mull over. We'll leave you with that paradox to think about the next time you look at your portfolio. Take one small action today, even if it's just automating a $50 monthly transfer. Thank you for joining us on this deep dive. Until next time.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.